Hello, everyone. Today is May 30th, 2022. I'm here today with Taylor Rotunno. This is Taylor's second appearance on the podcast. Taylor is a pharmacist and an investor. Thanks for coming on the podcast, Taylor.
Appreciate it. Thanks for having me back.
You're welcome. So we were talking about the calamity in the markets right now. It's very volatile, it seems.
Definitely. Yeah. It's uh easy to get wiped out right now for sure. It's a lot of things surging and a lot of things crashing super hard. So volatile would be the correct term. I agree.
Yes. And you know, it's been stocks and crypto, and we were talking about housing before this. And the last time you came on the podcast, we talked extensively about multifamily homes and multifamily real estate investments. And we were also talking about how real estate, comparing it to stocks and crypto, you know, it it hasn't it hasn't fallen quite the way the other assets or what's seen as assets and investments have.
Hmm. Agreed.
And you mentioned earlier that it's because it's or it doesn't it slows, it doesn't come as fast as a pace, or what do you believe the reason for that is?
I mean, it's with crypto, specifically you got a market that's open 24 hours a day, 365 days a year. So you have constant price feed to see where things are at. And then, with the stock market, it's similar, except it's, Monday through Friday. What is it? On the West Coast, 6:30 a.m. to 1 p.m. So you got that in time price feed that you can always see what your stock is trading at, what the stock market indices are trading at. But with the housing market, you don't have that real time indicator of these price feeds to kind of let you know where you're at. So, um, in many cases, things may be deteriorating already a little bit, but we don't have the data until, a couple months later, once everything's kind of been calculated and then, spit back out to the public. So I think you're already starting to see it on the edges. But I think you're going to see more material weakness coming in the months and 1 to 2 years ahead.
What do you mean by material weakness?
So as a example, just in the last month, if you look at sales of new single family houses, um, they decreased by 16% the purchases in the last month. And over the last year, it's down 27%. So, over half of that decrease has just been in the last month, 16% in the last month, but 27 in the last year. So you can see that there's really starting to be a deepening in this. And when you look at the number of houses that are under construction, naturally, since the prices are so high of new houses, there's a lot of different companies that are trying to build these houses right now to capitalize on the profit that can be made. That's a good thing. That's the positive aspects of capitalism working itself out. But when you have all of this supply of houses that's about to be dumped onto the market, and consumers who are pretty much tapped out at this point on what they're able to afford, you're going to have a glut of supply hitting at the same time that demand is diminishing. So that's kind of a recipe for things to start coming down rather quickly.
Is there an influx of homes being created at the moment?
There are. It's much higher than it's been in the last few years. It's not at the peak that it was in like the 2008 housing crisis, as an example. But normally, what you see before the crash in prices, or let's just say a decrease, because I guess a crash you'd have to define with like a certain percentage or something like that. But you would see a surge in the supply of homes first, and then once all of those housing companies, start laying off workers or going bankrupt, then the supply comes to a standstill at that point, and then you see the supply of houses crash along with the price. So I think we're kind of at that spot right now where you're going to see a build up and build up and build up of supply over the next couple months, and then a huge crash as these companies stop building. And they're these companies that are building are in a big predicament because the cost of building these homes has gone up. I think the most recent percentage I saw was year over year, their construction costs are up 18.2% year over year. So, I mean, that's just
Is this just within the last like 3 or 4 years, or is this all time?
for the construction costs going up.
Yes.
Yeah, so it really started picking up at the beginning of 2021. Um, and it's just been a relentless spike the last 16 months. It's like every single month seems to outdo the previous month. And I think for the last 4 to 5 months now, so pretty much all of 2022, the year over year number's been like over 16 or 17% for the construction costs. And going back to the data that Wolf Richter had at wolfstreet.com, he says that this is the biggest spike ever. His data goes back to 1964, and no year since 1964 has ever had construction costs this high year over year.
Wow. And what do you believe has contributed to that dramatic increase in cost?
I mean, there's a lot of things that additively all contribute to it, but at its most basic level, I mean, you have a pot of goods, and people have to contribute to the pot, and then people have to give their money to the pot to take things out. And over the last 2 years, there's been a lot of shutdowns due to COVID and other things, of people producing the raw materials that go into creating the houses, so you have less of those items going into the pot for people to spend their money on. And then at the same time, you have all this helicopter money and stimmies, or whatever people call it, and PPP loans. And I mean, it was the biggest flush of money to businesses and consumers that we've ever seen. So you have money aplenty, and the raw materials that people are seeking at a much lower level than they normally are. So you got more money chasing less goods. You're going to just have the price of everything go up. And you've seen that. I mean, the price of pretty much everything across the board has gone up in the last 2 years.
Yes, you have groceries, gasoline, homes, and it's all, when you bring it back to something like, what was the number for the increase? 17% for construction?
Yeah, like 18.2 is the most recent month for year.
18.2. That's huge. And so those supply chain costs get factored into our consumer costs.
Yep.
It's interesting because I think for you and me, we're in our young 30s, late 20s. This, we were there for 2008, but I don't know about you, but I didn't have assets. I didn't have.
I didn't have anything either. I mean, we're in college at that point, or I was in high school, actually, the last year of high school. So, I mean, at that point, I'm not following the stuff like I do now. It's definitely different for sure, being at this age, this time, and going through it, rather than, I will say that I'm kind of a nerd, and have read tons about what happened in 2008. So I'm very familiar with it now, but I didn't actually get to experience it in real time.
Yes, that's probably going to be a rewarding, action that you took on to read about it in 2008. And based off of your reading, what differences do you notice between 2008 and 2022?
Um, well, I mean, it seems like some of the mistakes have come back to kind of repeat themselves as far as just the amount of debt that the consumer is in, the amount of debt that uh, corporations are in, the amount of debt that our U.S. government is in. It seems like it just keeps rising exponentially um, for everyone, and at a certain point, all that bad debt needs to get flushed out of the system. And essentially, what we keep doing is, we keep, when I say we, the central banks have continually put pressure and lowered interest rates, artificially keeping them much lower than the market level would otherwise be. And that obviously makes having debt much more manageable when you can just refinance debt at a ever lower interest rate every year. But there comes a point that if those interest rates start surging, then that debt load is unmanageable, whether it be for the government or for individual people or for corporations. So, that bad debt needs to get flushed out of the system. There's a lot of companies that are extremely unprofitable, and the only way that they're even able to stay afloat is because there's all this cheap money that they have access to that keeps getting injected into it. So it's just bad money chasing after bad money, chasing after bad money. So, those companies that can't make it without market level interest rates where they should be, I mean, they ultimately need to fail. That's that's capitalism at its core. Propping up these companies is not capitalism.
No, it's not. And it really, really hurts the individuals, the consumers, and the competitors, startups. I mean, really, like, I think one thing was the aviation industry. You know, people say, oh, we needed to bail them out. We couldn't have, you can't have Delta failing, you can't have United failing. Well, maybe, those airlines, they had some practices which were not forward thinking. They weren't safe. They weren't implementing safety procedures. They didn't have enough stockpile of reserves for a time such as COVID, even though we've all known about, swine flu has occurred and there were similar restrictions. 9/11 occurred and there were similar restrictions on airlines. So airlines know that there may be these extreme events that occur that will force them to shut down operations. That has happened before. That happened before 2020. And so, my argument for the last 2 years has been, let them fail. Some billionaire, maybe a Jeff Bezos, buys the airplanes for pennies on the dollar, buys the rights for or rents the rights to terminals within various airports around the world, and provides, he those companies fail. Most of the employees transfer over to the new company because the the product, the service is still going to be needed one day. When all of it returns, it's still going to be needed. But the people running the show, the actual corporation, obviously, or in my opinion, they were doing these very questionable financial decisions with their stock buybacks. And, that's not, we can't just say, oh, you did this, it's too late now, we can't let you fail. No, that's the thing, you alluded to it, is that the corporation is an individual. The corporation has to be able to fail. There is no such thing as too big to fail. I mean, what do you think about that?
I completely agree. I mean, they've created the biggest moral hazard that we've ever seen. It's the heads I win, tails I win situation.
Yes.
Why would they not buy back stock at egregious levels when they know that if shit does start to hit the fan, that ultimately the government has their back, which ultimately means the taxpayers have their back. So it's like they know that there's no repercussions for them engaging in otherwise risky behavior that could compromise their company, because they know, like you alluded to, they're too big to fail. They contribute too much to the campaigns of these politicians, and they would never let it happen to these companies.
It's very unfortunate. And what's interesting about lobbying is that it's literally, I mean, in my AP political science class, I was taught about lobbying, which is interesting. It is institutionalized within our political system, and it's very, very controversial right now.
Oh yeah.
What do you think about it?
I mean, I think there's a lot of things wrong with our political system, and I think that lobbying is probably one of the biggest. That if you took that out, you would see massive changes, because like I said, ultimately these politicians are beholden to these corporations, because they are by far the biggest donors to their campaigns. So whatever interest those corporations have, they have to essentially abide by them if they want to have any shot of getting reelected in the future. Or they're not going to have those dollars funding into for their reelection campaigns. So I mean, lobbying is I mean, everyone can see it, that it's an extremely corrupt practice. But like you were saying earlier, when they were teaching it in school, it's almost like they tried to make it seem like it's a part of our democracy or something. Like lobbying is good, but you may not see it when you're in high school. But I think most people, once they start to see our age, that nothing good comes from being able to buy people out with money, when these are ultimately the people that are making the decisions that affect everyone's lives. And these are people that hold stock in a lot of these companies and are allowed to trade in and out of these companies, and then make the laws that dictate what happens to these companies. So just as an example, these people could have stocks in like the defense companies, the Northrop Grumman, the Raytheons, and then pass a bill that we need to go to war, or we need to send more money to Ukraine. I mean, it's the ultimate conflict of interest.
It is the ultimate conflict of interest, and it's obvious. Everyone knows about it. Everyone kind of talks about it too. Yet we just allow it to continue and continue. And I'm a little optimistic because of the evolution of social networking and information transfer. It's not so easy to do more or less anything in private. And so we their country, countrywide news headlines that will name a politician and what investments they made that day. That happens regularly. Like, we know who's invested in what. It's public information. We know when they're investing in it, when they're not. And not only that, the media is also putting that in our face. And it's easier to get than ever because of the internet. And that changes things, because now, before, I don't think everyone knew, this aspect of, oh, this politician's purchasing this stock and selling that stock. And then, oh, but then this is also going on too. It's like, what in the world is happening? But at least because of social networking, because of the internet, these things are very difficult to keep quiet anymore to not have in the public sphere, in the public image. And I don't know if that will change things, but it might. And
I
I
think it has started to. I mean, just like as an example, you may have heard about the scandal of two of like I think it was the regional Federal Reserve Bank presidents. Two of them got caught trading in and out of um, different stocks, I believe it was, during the past couple of years that seemed very, obviously they dictate monetary policy in this country. So, they have inside information on, where interest rates are going and what they're going to do. So if they're front running that situation, I mean, that's like the most um, egregious, uh, way of using your insider knowledge to profit from a situation. And both of those guys, I mean, to be fair, they're both at the end of their career anyway, so they probably didn't want to work that much longer anyway. But they both ended up resigning from after that came out. So I mean, I think they are feeling the pressure now.
I agree. I think they are feeling the pressure, and I hope something budges regarding that. It would be really interesting. I read a biography on Benjamin Franklin, and his belief was that the president shouldn't be paid at all. Like, just if you want to do it, that's yours, but you're just going to do it. And that's a little tough to say because maybe afterwards they can get very wealthy, like Barack and Michelle Obama after the the Barack's presidency released books and became uber successful with their books. At least Michelle Obama's book just took off. And so, but his argument was, in office you don't get paid. And it would be really interesting to see that happen if lobbying was cut. Like you said, there would be dramatic changes, like more or less, people, it's pretty obvious when someone's like, just again, because privacy has literally, I would say privacy has almost been abolished in today's world. There are literally cameras everywhere. There are microphones everywhere. In everyone's pocket, there's a microphone. And so I just think privacy has, more or less just, we can almost completely forget about it, especially for someone like a politician. And so, who, what they're doing is so important to everyone around them that everyone's eyes are always on them, that it's obvious if they start, their wealth goes up or down because they're in such the public eye. And so if we are able to keep politicians while they're in office accountable to maintaining, to not, while you're in office, you can't, make above a certain, living. I mean, you can have all your food, housing for free. That's very tough because then they retire. It's kind of like a veteran where, they're retiring and then who knows what happens. But then a career politician would have a very difficult time making millions of dollars, becoming super wealthy. And maybe that would be a bad thing, but that would be very interesting.
Yeah, I agree. I mean, I don't know the exact statistics on it. I probably would go out on a limb and say that for most politicians, they make much more money. That's not their government mandated salary from outside book deals, from speaking at uh, different conventions and things like that. Um, all these different things where they essentially use their fame and power to um, people want to hear them speak and hear what they think, and that has a lot of value attached to it. You know, someone that everybody knows. Um, so, I mean, I don't know for sure how much of a difference it would make. Um, it's hard to know. for certain, but I do agree that it would probably be a step in the right direction, at least, along with limiting, like I said, the conflict of interest. If you do, you know, first, I don't even think they should be able to allow to own, you know, equities of companies that they're passing bills on and things like that. But if they do, let's say there's as an example, a bill where they're trying to make vaccines mandatory or something like that. I mean, would it really be right for a politician who holds stock in Pfizer or Moderna to be able to vote on whether we should be able to mandate vaccines or not? I mean, that's such a conflict of interest. I just think that
Absolutely.
sounds right to anybody.
Say that again?
I just don't think that sounds right to anybody that they should be able to do that.
No. And that sort of conflict of interest wasn't so obvious before, whereas now it's in our face and everyone knows, like, oh, you own that? Okay. You own that? All right. You just sold that and bought this one? Okay.
Mm-hmm.
It's kind of crazy.
Yeah.
So last year when we spoke, you were very interested in multi-family home investments.
Mm-hmm.
And I guess, has there been any evolution or any change in your thinking regarding multifamily homes and, especially with the current economic climate, how are your feelings towards that industry?
So I do believe multifamily to be one of the more resilient sectors within real estate specifically. Um, if you look at what's happened in the retail real estate section and the office real estate, I mean, they've just gotten absolutely hammered uh, in the last 2 years. There's just a glut of vacant retail buildings and office buildings in cities all over the U.S. So anyone holding debt or equity in those buildings have taken a big haircut on their value. Obviously, with multifamily by nature, these are people who need somewhere to live, and they're renting an apartment from you. So if times are tough, and let's say there are an increase in the amount of foreclosures in the economy on single family homes, those people getting foreclosed on their home, where do they go? They go live in an apartment. I mean, most of them. I mean, not some will go homeless, but most of them are going to cut back. They were probably living maybe a little outside their means with the house they were in, and they're going to go live in an apartment. So um, there's different, even within apartments, there's different, categories as far as new apartment buildings versus apartments that are maybe 20 years old. You'll definitely see a divergence in how successful those do, because if there is a massive downturn, um, the amount of people who are going to be putting in applications for a brand new apartment building is not going to be as high. People are going to be searching for better values on those buildings. So, but ultimately, I think the multifamily in general, as you could see, is from those factors, it's much more resilient than a single family home is, as an example. And another good way to think about it too is, let's say you have, just one investment. You own another single family home and you rent it out to a family, let's say, and times become tough and they're not paying anymore, let's say, and you have to evict them. But then you can't get anyone else in there. The economy is just too rough. But ultimately, you still have your mortgage payment that you're having to pay, but you have no money coming in on it. So, I mean, that's depending how much money you have saved up. I mean, that's eventually going to become catastrophic for you. You're not going to be able to afford that mortgage payment. But in an apartment's case, for example, let's say you have a 10-unit apartment building that you own, and let's say, in that situation, it was full. You had 10 people in there, but now, due to a downturn in the economy, you only got 6 people in that apartment. Well, you still got 6 people paying. You might not be making any profit anymore, but maybe you're breaking even now after your mortgage. So it's not so all or nothing where it's like either making zero or you're making 100. In that case, it's like even if you lose a couple, you still have that buffer of the other units who are still helping to contribute to the mortgage that you're still obligated to pay in the end.
Wow. I never thought of that. That's huge because then you're never, I mean, there's still going to be vacancy, but it won't be like you said, all or nothing, which is all or nothing aspect is like the most stressful part.
That's when something has to give if you don't have enough reserves built up, and it goes on long enough.
Yes. Wow. That's very I'm glad you brought that up because I'd never thought of it like that. And when you look at multifamily home investments, real estate investments, are you looking what what are you looking for?
So the the niche within the multifamily that I personally believe to have the best risk reward profile, where you're getting the most bang for your buck on how much risk you're taking, is what they call the value add multifamily strategy. So essentially, you're trying to buy a building that in some way you're able to add value to the property. And essentially, what you're doing is you're forcing appreciation into the property. So, let's say you have a building that's 25 years old, and compared to the buildings that are maybe there's other apartment buildings that are also 25 years old, but those all rent for like 150 to $200 more than the apartment that you're trying to buy. So you look into it, you're like, why is this building renting for less? Well, it hasn't been painted in 20 years. There's some broken windows that aren't being fixed. The pool is out of commission. They haven't kept it up. Whatever you see that essentially can be approved upon, and essentially you take over that asset, and uh, you fix whatever things you need to make it comparable with other apartment buildings that are of a similar age to the apartment building that you have. And ultimately, over time, you should be able to increase the market rents to the market rents that the other buildings are fetching over time. And then you can either hold on to the asset, or you can dispose of the asset by selling it, or you can refinance at that time and pull out a bunch of cash and return it to yourself or your investors at that time. So um, you have you already see that other houses or other apartments are fetching a certain amount, so you can be rather certain that you can fetch a similar amount if you provide the same amount of value that those other apartment buildings are providing. Um, that's kind of I guess the short and dirty way to think about it.
Okay. So find a property, a building you can add value to that is currently being undervalued by in relativity to the buildings around it.
Correct. Exactly. So you can, uh, like I said, the term of you'll hear a lot is force appreciation. You can force appreciation into the asset, which in single family, it's all based on essentially the value of the property is all based on comparable properties. So if you're in a house and then there's a house right next to you that just sold and it looks just like yours, your house's value essentially is whatever the most recent house that looks like yours just sold at. But in apartment buildings, it's the value of your building is all based on the cash flow of the asset. So if you increase the cash flow of your asset, the apartment essentially, it's a business. It's not a single family house. So if you increase the rents by $150 a door, you just increase the cash flow of that asset. So if you want to dispose of that business afterwards, it's you've just appreciated the value of that business by increasing its cash flow.
That makes sense. Wow. And looking for these buildings. So most multifamily home real estate, I see like one apartment or one condo for sale, but how does someone get involved with investors? Maybe like what would you do to get, that those investors on board? To say, say you find a building you like, what would you consider? What do you think is required?
For someone that's uh, never done it before, essentially, and is trying to get into the space.
Yes.
Um, so there's definitely some different strategies and ways you could go. One way is to essentially team up with somebody who has, obviously done it before and has the experience. And, in that scenario, um, you'd essentially be doing it much more for the experience than you would be for the pay. You'd be able to have it on your resume that you did X and X for this property, along with this other person, so that going forward in the future, you have confidence in people wanting to invest in the property as well. Um, Another way would to buy a smaller asset. So, like let's say your goal is to buy apartment buildings that have 100 units in them. Obviously, that's going to be extremely difficult for most people to raise money for if they've never done it before. So, starting slow and maybe buying a 5 unit apartment building that maybe you can afford with maybe you and one or two other family members or close friends, and show that you were able to uh, increase the value of that asset and ultimately provide a very sufficient return on the capital, and then uh, dispose of the asset. And uh, there's something called the 1031 exchange, that essentially what you can do is you can sell the asset, and rather than pay the taxes on the capital gains that you've made from the asset, you can roll those capital gains into the purchase of another building. So let's say you bought a 5 unit building, and over a couple of years you made $500,000 on it. So rather than selling it and having to pay taxes on the $500,000 of gains, you can just roll that money and say, now I'm going to buy a 15 unit apartment, and I'm going to use that money as my capital gains uh, for the new apartment. So it's essentially the government incentivizing you to, um, you're being rewarded for providing value and making a profit on that building. And now they're encouraging you to use that profit to do that for another building of an even bigger size, rather than, having to pay the capital gains tax on that. So you can slowly, over time, go from a bigger and bigger and bigger and bigger apartment as um, continue to have those capital gains that you roll over into the next apartment.
Would that require an investment every year?
Um, as far as getting another building, or
Or as far as taking advantage of the capital gains tax cut? As say you wanted to get your 20, say you made the gains in 2020,
uh-huh.
and then would you have to put that money in
Yes.
2021?
Yeah, so there's I'm trying to remember the specific rules. I think the grace period is something like 180 days. Um, that once you dispose of the first house, you have to have already closed on the second asset, I think within 180 days. So if you don't, then you have to ultimately pay taxes on the capital gain. So it does have you have to be a little bit forward thinking, where you kind of already have something else set up that you're looking to purchase as you're selling your current asset. Otherwise, you'd be required by IRS rules to pay the capital gains.
Okay, that makes sense. And another question I have is, we live in Southern California. We have some of the most expensive real estate in the world. And do you look outside of Southern California for your investments, or do you want to keep them close by?
Um, I personally only look outside of California. Um, I I personally look for states that are a little bit more landlord friendly than tenant friendly. It can kind of be a nightmare. Um, dealing with the laws and regulations in California. I mean, like as an example, um, if you were to have to try to evict a non-paying tenant in California, I mean, it could easily take a year to get them out of your place. And if you don't have the reserves um, in that situation, I mean, your house is going to get foreclosed on, or or whatever property it is. So, um, I would want to invest in states that they kind of honor the rule of law, and if there's someone who's not paying, they're not able to essentially use loopholes in the system to delay and delay and delay the situation. And um, a lot of states in the Midwest and the South are much more um, friendly in that regard, so to ensuring that the landlords don't get unfairly taken advantage of in this situation.
Is there any what states do you like the most?
I mean, there's a handful. I originally, when I was doing my research, was really looking in Indiana a lot. I ended up making one investment in the past year, and it was in Western Texas.
Wow.
So, I mean, the jury's still out on how that investment will ultimately perform. I'm hoping it turns out well. But we'll see.
Multi-family home?
Yeah, it's like 100 and I believe like 110 unit or so,
Nice.
multifamily. I'm obviously a very small part of that uh, investment passively, um, that I invested in it, and there's definitely been some. This was a more of a renovation heavy project than some of the other ones. I think when we took it over, the occupancy was only like 40%. This thing had really been neglected severely. So,
When
um,
was it built?
trying to remember the details now. I feel like it was in the 80s. Um, and essentially it was in a downward spiral where it was like they weren't making, they were losing cash every month on the place because their costs were exceeding the money they were pulling in from the rents. So then they didn't have money to make the renovations. They didn't have money to paint the walls or put a new carpet when a new tenant came in. So it was like you can slowly see how that turns into a death spiral where like you don't have money to put into it, so then no one wants to come in, and then you have less tenants, and then you're making less money, and then before you know it, you're bankrupt. So, um, able to in this case, buy an asset that was, you know, much cheaper than it otherwise would have been. But one of the things that's been difficult with this project, and we talked about this earlier, was the construction cost, and I think uh, the projections were that we were going to try to put about $2.2 million of different renovations into the project, and it it definitely looks like it's going to go over. I think we had about a $400,000 cushion that they had raised extra money, in the case that things went above the projected budgets. So I'm hoping it doesn't go, over that extra $400,000 cushion, but there's definitely been a massive increase in um, the prices of these renovations than I think were projected just in like 9 months ago in July of last year.
Wow. That is going to be very interesting how that plays out in the next year.
Yeah, ultimately, I mean, we got to get to cash flow positive on the asset, because if it hemorrhages money for too long, then it's not sustainable. So it's all about being able to turn that cash flow positive before we run out of money. And in the case that we don't, we'd have to likely inject more money into it at that time. I would just be hoping that we're not throwing good money after bad in that situation if that were to come.
Yes. Cut your losses if it's required.
If it's required, exactly. So we'll have to see what comes of it. Ultimately, it's definitely too early to tell. And like I said, it has massive upside if we're able to turn this thing around in time.
Good luck. I hope you guys are able to do it.
Yeah.
So last year when we spoke, I don't know. I believe you weren't very enthusiastic about cryptocurrency.
I had just, I think, started to dip my toes into it, so to speak.
Yes. And when I just dipped my toes into it, I wasn't that enthusiastic about it.
Yeah.
But how how have you, what have, after, diving deeper, what have you learned, and how are you feeling about it as far as, you know, being an asset or a currency?
So really, the the game changer for me um, was when I learned about what decentralized finance was. When I learned what that was, that kind of opened Pandora's box. Like, whoa, this is something big. Like
Yes.
this is this is possibly like when the internet first came out. Like it has that big of wide ranging um, applicability to different things. So I kind of went down the rabbit hole, maybe April or May of last year. And at first I was just reading. I wasn't just FOMOing in and throwing all my money at different things. I was just trying to
Yes.
learn as much as I could. And um, just as some examples of like the implications of some things that blew my mind. So um, Aave, for example, it's an open source protocol um, that it's non-custodial, and you're able to deposit your funds into a smart contract and earn interest um, on those deposits. And then other people who have deposited in there as well can borrow from the pool of assets that are in there. So essentially, it cuts out the middleman. It cuts out the bank, essentially, because you're just interacting with a protocol that's the code's already written, and the code just
Yes.
does what it's already designed to do. So right now, for example, USDC, which that's a stable coin, and you can deposit that into the smart contract right now. It yields 1% about on the Ethereum chain right now. And someone who wants to borrow USDC can do so at 2.2% interest. So that's a spread of only 1.2% interest. So, I mean, when you think about this in the traditional world, I mean, you go to a bank and you deposit your fiat US dollars in there, and you're making like 0% interest. They like don't pay you anything essentially. And then, in the more extreme example with your credit card, when you want to borrow money against them, you're paying over like 20% interest. So they're paying people who are providing them money 0%, and then they're charging other people who need the bank's money 20%. So there's like a 20% spread that they're making on the interest in that situation. But in this situation that we just talked about, you're depositing at a 1% interest rate, and then people are borrowing at a 2.2%. So there's only a 1.2% spread on that. So obviously the banks are going to be extremely threatened by something that's able to do that.
Yes.
And that kind of blew my mind when you're able to essentially cut an intermediary completely out of an industry. Um, and it's really going to I think take off in the next decade. We're really going to see the banks are going to have to adapt to uh, this situation, because it's a big threat for them.
It's a huge threat. And everyone, I mean, many people kind of want it because, you know, it's decentralized. There's no middleman. There's no, someone's getting really, really wealthy by, making that 20% margin in interest. One thing you mentioned, the housing market, we get kind of the costs and what occurred a couple months after everything's settled, after all the transactions have been made. We don't really know what's going on in the real estate market at the moment, and we have to wait to find out what happened previously. I think there are use cases for DeFi, decentralized finance, DeFi, I'm not sure how you pronounce it, and real estate housing deeds being maintained on blockchains or public ledgers, maybe not specifically blockchain. There's also DAGs, decentralized cyclic graphs. I don't know if you've heard of them,
I haven't.
but okay, just it's another public ledger.
Uh-huh.
And so you can keep all of the transactions for the houses on the ledger, blockchain, whatever, and you can have apps, decentralized apps, pulling that information and kind of just putting it into a real-time stock market app, but being housing prices. Like you just find a boom, 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 boom. And it's
More real time.
much more real time, much more authentic. There's people reference Zillow and Redfin and all these things, and they're not 100% accurate. Like I'm a realtor, so I have access to, I pay money for access to a database that is much more, I don't know what to say, but it's the legitimate database. Whereas Zillow and Redfin derive from that, and it's not always correct.
Uh-huh.
And they derive from others because mine is only in Southern California and they derive from all over this country.
Mm-hmm.
But then people will get, the most accurate renting, rents between landlords and renters, put that on a blockchain or on a public ledger. And then you have real-time rent prices, but everywhere in the building. And so there are a lot of use cases beyond a currency. I don't, people consider them assets. And what do you think about? I mean, you're using it in the DeFi use case. I mean,
Yeah.
I haven't heard of it, but it's genius, and it can be used for home mortgages as well.
Yeah. I mean, here's like another like crazy example of something that you just wouldn't be able to do. This is like something only rich people do. So, like when you make a lot of money from an investment, if you sell that and realize that profit, then you have to pay capital gains on that profit. So let's say you invested $10,000 in some sort of cryptocurrency project. Let's say it went through the roof, and now the coin is worth $500,000. Let's say at present day. So you went from 10,000 to $500,000 of gains, or to 500,000. You have a $490,000 gain on that asset. So in the case of a lot of rich people, what they do is they just, rather than selling it and realizing that gain and having to pay taxes, they just borrow money against the asset. So like you would do with a mortgage, you do like a cash out refi, you can pull money out of your house. In that case, you're not realizing a gain, you're just pulling equity out of your house, and you don't have to pay any taxes on it. So what you can do in this case is there's a protocol I use called Chi. So you can deposit your collateral into their smart contracts, and then you can mint their stable coin, which is called MAI. You can mint it at 0% interest. So in this case that we were talking about earlier, that you could put your $500,000 into this protocol. Let's say you have $100,000 of student loans that you want to pay off. Rather than selling 100,000 of the $500,000 of assets and having to pay 100,000 in capital gains, you just borrow $100,000 of MAI against your collateral, that $500,000 collateral. You convert that MAI back into US dollars, you take it out of crypto land, and then use that $100,000 and pay off your student loan. And you didn't have to pay any taxes on that at all. And you still have your $500,000 collateral in that case. So that's not something that everyday people used to be able to do. That was like only rich people could borrow against their assets like that, before, but that's opened it up to everybody.
What would that collateral be? Like a home?
It could be like any cryptocurrency, like in this
Okay.
case. So let's say you bought Ethereum at like $100 back in March of 2020, and it went up 20x, close to 2000 or something now. So you made an insane amount of money. And you know in California, for example, the capital gains taxes are much higher than other states. So you may have if you're in the 24% tax bracket federally, then you'd also have to pay another 9 to 10% of California state income tax. So I mean, you're looking at like a 33% capital gains tax on, if you sold $100,000 worth of coins, and they would take 33,000 of the 100,000 that you sold. But in this case, you could just borrow against your collateral and pay no capital gains.
And then do you have to pay back? Do you have a loan then with this?
Yes. So you have a loan in that smart contract now. So the only way to unlock that collateral is to pay back the $100,000 of MAI that you borrowed. So you have to eventually pay that back to get back the collateral, or you can just use your collateral to pay off the debt as well.
Okay.
And obviously, the risk that you're taking in that case is that if the value of your collateral does crash, then it's eventually going to hit the point where there's a liquidation price. And if it gets down too low, they're going to ultimately sell off your collateral to pay back your debt if it hits a certain liquidation price. So you are taking more risk in that situation, especially if your collateral is an asset that's extremely volatile that you're using.
So that's written in the contract that if it hits the liquidation price, they have the right to liquidate the asset and take everything.
Yep. And that's
or whatever they're owed.
For MAI to maintain its stable peg price, because the whole basis of MAI is that it's over collateralized by the collateral in those vaults. So that if the value of the collateral in the vaults becomes less than the debt positions that people have, then that MAI coin is no longer sufficiently collateralized and is therefore not worth $1 anymore. So the only way to keep it worth $1 is to always have the total collateral in that protocol higher than all the debt positions combined that people have.
So the coin is collateralized on other crypto coins.
Correct.
Wow.
And
that's
you
genius.
can borrow it at 0% interest. The only fee, the way they make their money is when you pay back the MAI. So let's say you pay back the 100,000. When you pay back the $100,000 of MAI, there's a one-time 0.5% fee on the MAI. So that's a $500 fee on $100,000, and that's the only fee you would ever pay the whole time, rather than rather than like $33,000 of capital gains tax like we were talking about.
Dude, wow. And that's for every loan, not right?
For that protocol specifically, like they're all 0% interest. There's different protocols that charge you like a small amount of interest, and they do it a different way. But that protocol, and I know of that one because I use it, so that's why I can speak to it more. But yeah, 0% interest on that protocol.
These use cases are very applicable to everyday life, and when you hear more, the use cases when these things hit home. I mean, for you, it said decentralized finance. For me as well, it's like when you realize, oh, this can do almost any transaction we make can be placed on this, especially ones that involve loans and and literally public ledgers. Like I wrote an article managing military supply chains on public ledger technology, and the military runs on a transaction in a transactional format. That's how they really maintain a lot of metrics, is dollars. And because it's such a huge organization, it's like the best metric, putting there, what did we save, what did we gain here, did we save money by implementing this? And so when they're supplying out equipment to various ships, factions, or not factions, but like brigades, whatever you call them, groups of soldiers, planes, it's all done in a transactional format. And so, and everyone needs to know about it within that organization. So there's still a use case, even with a not fully decentralized network. Still, that's a permissioned network, I believe, where you need permission to access the network. But still, everyone needs to know where that money's going, where that equipment's going, and then the public ledger is able to communicate that. And with these use cases like loans, like you put in money, it's staked at 1%, and then people can take out their loans at 2.2%. It's I'm That's a lot of people in the banking industry. That's a lot of money in the banking industry. Those are some elite corporations, some of the most elite corporations in the world. And so, and it's important. Like, I have a mortgage. I appreciate taking out a loan with one of the big four banks. Without it, there's no way I could have afforded this house. But if I can't even imagine, like if someone is able to stake this house at a much lower rate, I mean, the refinancing aspect a year, 2 years ago was great, but still that was unheard of and debatably unresponsible. And so, but if we have private investors who are willing to stake their own funds to get something back, and then I can take advantage of that, get a better loan. I mean, that's a lot of people that we're cutting out. That's not just one middleman. That's one of the biggest corporations in the world, one of the most profitable corporations in the world that also was bailed out in 2008, very similarly. And so that's a whole nother topic, but cutting out that middleman is critical and
It's to the benefit of
the
everyone.
benefit of everyone. And going back to what we talked about earlier with lobbying, I mean, imagine if all lobbying donations had to be placed on a blockchain, on a public ledger. I mean, it's just the way money moves it's interesting.
Very interesting.
Wow. All right, so Taylor, I think we're going to start wrapping up soon. Are there any other aspects of investment or markets that have you excited or intrigued?
Well, I would say the last time we spoke, like I said, most of my attention that previous year had been focused specifically on multifamily housing. This most recent year, I've really dove into the crypto and the DeFi aspect. I had already kind of been previously to that interested in stocks and things like that, and macroeconomics, just the general overall economy of the world. But over this past year specifically, I would say crypto is the thing that I've really enjoyed learning about the most. But I really saw it as, once I learned about the decentralized finance, just another thing in my arsenal that I can use to ultimately deploy capital in the most effective and efficient way possible.
Absolutely. And I think you hit it right on the head there. It's another tool. It's not, you're not going to just throw all your money into a single crypto. It's in your portfolio now, next to the multi-family home real estate, next to other, stocks and, maybe a little bit of cash and commodities, whatever that may be. Actually, I did want to talk to you about that. Are you invested in any commodities?
So there's a number of commodity producers that I'm invested in. So specifically oil and gas companies. It was about a year ago, May of 2021, when I did increase my positions quite significantly in that sector. I just saw some tailwinds that I thought that would be in my favor going forward.
What
And
were those tailwinds?
I mean, to put it simply, I mean, we've really demonized the oil and gas industry, um, in the last decade. You know, different ESG, mandates, and ultimately, all those ESG mandates are making it so there's less capital that's being deployed to that industry, which is a very capital intensive industry. You have to keep injecting money to maintain these oil wells, to find new oil wells, and if you don't, um, you can't use, them anymore. So essentially, we've gotten to the point that we've underinvested for so long that the supply is no longer enough to meet the demand, which is steadily increasing. And when you have a supply that can't meet demand, I mean, there's only one thing that can happen: prices have to increase. And with something like oil and gas specifically, I mean, it's not very, it's very inelastic in the pricing mechanisms. I mean, with other things that aren't so that people can cut out of their lives, you're not going to see these price explosions, because if the price starts going up, people are just going to cut back. But I mean, you can't cut back on, it's the winter and it's freezing outside and you need to heat your house. I mean, there's only one option: you pay the price for it. I mean, so the amount of demand only goes down so much when the price increases. And I knew that, you know, if the supply is not sufficient to meet that demand, then there's only one thing that can happen, and the price has to go up.
And it skyrocketed.
It's absolutely skyrocketed in the past. I think 2 years ago, the price of a barrel of crude was $35 a barrel. And obviously, that was depressed from the
COVID.
depressed demand from COVID at that time. But then, as it started more normalizing about a year ago, the economy was more or less back to normal. I'd say, as far as people's trends on driving and things like that, we were up to $70 a barrel, so it doubled in 1 year. And then in the past year, it's gone from $70 a barrel to $120 a barrel. So close
Wow.
to doubling again.
So quadrupled in 2 years.
Yeah, quadrupled in 2 years. And there's really if you look at the chart of it, it just looks like there's no end in sight. It's just like relentlessly going higher.
And we're not going to get off oil anytime soon.
That I agree, and I think that was the mistake a lot of people made, was thinking that, if we cut the oil out right now, we're good with all the renewables we have, but we're not even close to having the renewables we need at this time. And I think people are coming to the realization that they're a necessary evil, until we're able to ultimately meet that supply of energy, because ultimately energy is life. Energy is what moves everything in the economy. Without energy, I mean, it's widespread famine, it's widespread death without energy.
Absolutely. It's critical. And so we definitely need to be aware of how we produce energy and what the constraints are on it.
Agreed.
So, Taylor, are there any last words or closing remarks that you'd like to leave our audience?
I don't think so at this time. I mean, I think we covered a wide array of different subjects, and I'll definitely be interested to keep in contact with you and talk with you in the future as things continue to develop in these different sectors of the economy, because it's definitely going to be an interesting time these next couple of years.
Yes, I'll be interested in keeping in contact as well. My guest today has been Taylor Rotunno. Thanks for coming on the podcast, Taylor.
Thank you. Take care.
Take care.